Hey everyone, Karan here from Life Accounting, where we help you save on taxes and increase your wealth. And today I'm going over the absolute best tax credits available for everyone. Now, I say everyone because most tax credits in the United States are reserved for business owners. But you may be eligible for the tax credits in this video whether you own a business or not. So let's dive right in. Okay, I want to quickly make sure you understand the benefit of a tax credit. You see, tax credits directly reduce the amount of taxes you owe, giving you a dollar for dollar reduction of your tax liability. So, let's say you owed $1,000 in taxes. A tax credit of $500 would reduce the amount of taxes you owe by exactly $500. Meaning, in this scenario, you would only owe $500 in taxes. So as you can see, tax credits are a powerful tool as they directly reduce your tax burden and not just your taxable income. To add icing on the cake, right? Some tax credits are refundable, meaning they can help you get a tax refund or even increase the amount of your tax refund. Okay, let's get into the list. First up is the Earned Income Tax Credit. You see, the Earned Income Tax Credit, also known as the EITC or EIC, is a refundable credit for low and moderate income taxpayers. The Earned Income Tax Credit for 2021 provides a tax credit ranging from $502 to $6,728, depending on your tax filing status, income, and how many children you have. In general, the less you earn, the larger the credit. To qualify for the Earned Income Tax Credit, you must do the following. Show proof of earned income, have investment income below $3,650 in the tax year you claim the credit, have a valid Social Security number, be a U.S. citizen or a resident alien all year, and claim a certain filing status. Eligible filing statuses include married filing jointly, head of household, qualifying widow or widower, and single. You can't claim the EITC if your filing status is married filing separately. All right, number 2 on the list is the Residential Energy Credit. Hey, Uncle Sam likes energy efficiency, so much so that you can get a tax credit when you install appliances or make improvements that boost your home's energy efficiency. Examples of qualifying appliances or improvements include windows and doors that are energy efficient and solar-powered water heaters and roofs. The tax credit is based on the cost of equipment, including installation costs. Here's how the tax credit works. You get a 30% credit for systems placed in service by December 31st, 2019, a 26% credit for systems placed in service after December 31st, 2019, but before January 1st, 2021. Then you get a 22% credit for systems placed in service after December 31st, 2020, and before January 1st, 2022. The full renewable energy tax credits are good through 2019 and then are reduced through the end of 2023. And you claim these credits by filing Form 5695 with your tax return. Here's something to note, that existing homes and new constructions qualify for the energy credit, but rental properties do not. All right, number 3 on the list is the American Opportunity Tax Credit. If you paid for qualified higher education expenses, the American Opportunity Tax Credit, AOTC for short, allows you to get a maximum annual credit of $2,500. Now, the AOTC can be used for up to 4 years and expenses you claim, including tuition, fees, and course materials. The following expenses do not qualify for the tax credit, and that's room and board, transportation, insurance, medical expenses, student fees unless required as a condition of enrollment or attendance. If the credit brings the amount of tax you owe to zero, you can have 40% of any remaining amount of the credit up to $1,000 refunded back to you. The amount of the credit is 100% of the first $2,000 of qualified educational expenses and 25% of the next $2,000 of qualified educational expenses. Now, this credit does begin to phase out for higher income parents and completely phase out if your modified adjusted gross income is over $90,000 or $180,000 for those filing jointly. All right, number 4 on the list, the Lifetime Learning Credit. The Lifetime Learning Credit is a non-refundable tax credit that is worth up to $2,000 or 20% of the first $10,000 of qualified educational expenses each tax year. Qualified educational expenses that can be paid by the parent include tuition, fees, and course materials. Unlike the American Opportunity Credit, which can only be used for the first 4 years of undergraduate studies, the Lifetime Learning Credit can be used for undergraduate and graduate studies, including eligible professional programs and trade schools. Now, the credit can only be used once per year. Also note that the credit does begin to phase out for higher income individuals and completely phases out if your modified adjusted gross income is over $69,000 or $138,000 for those filing jointly. To be eligible to claim the ALTC or the Lifetime Learning Credit, you must receive Form 1098-T from an eligible educational institution. All right, number 5 is the Premium Tax Credit. You see, the Premium Tax Credit is a tax credit used to lower your monthly insurance payments when you enroll in a plan through the health insurance marketplace. The tax credit you're eligible for will depend on the income and household information you use when applying for healthcare through the marketplace. In general, individuals and families may be eligible for the premium tax credit if their household income for the year is at least 100%, but no more than 400% of the federal poverty line for their family size. The Department of Health and Human Services, also known as HHS, determines the federal poverty guideline amounts annually. The government generally adjusts those income limits annually for inflation, and the Federal Register publishes a chart reflecting these amounts at the beginning of each calendar year. Number 6, the Child Independent Care Tax Credit. The Child Independent Care Credit allows you to write off a large portion of qualified expenses if you pay someone, such as a daycare, to care for your child while you work or look for work. Children who qualify for this credit are children ages 12 or younger at the end of the year, who you also claim as a tax dependent on your tax return. Now, the expenses that qualify for this tax credit include the following items: educational expenses, such as payments you make to preschool or other programs below kindergarten level. Then you have expenses for babysitters, nannies, or housekeepers. Summer camp expenses are also eligible, though overnight summer camp expenses do qualify. Transportation expenses, such as payments to a care provider to transport your child to and from where care is provided. Before and after school programs are also eligible, and expenses for care outside of your home to a dependent care center or qualified personal care provider. For the 2021 tax year, you get 50% back for up to $8,000 in qualified expenses for one child or $16,000 for 2 or more children. This credit does come with a few income limits to be aware of. If you earn between $125,000 to $400,000, the percentage will incrementally decrease from 50% to 20%. And if you earn above $400,000, the credit will phase out by 1% for every $2,000 above $400,000. Qualifying children for this credit are children aged 12 or younger. Number 7, the Child Tax Credit. The Child Tax Credit, often referred to as the CTC, is a refundable credit granted to parents for each qualifying child. For 2021, the credit is $3,600 per child under age 6 and $3,000 per child for ages 6 to 17, and can be received in advance via 6 monthly payments that started on July 15th. Now, the intended purpose for the credit is to help low to middle income taxpayers and begins to phase out with families with high income. According to the IRS, for the 2021 tax year, a qualifying child is an individual who does not turn 18 before January 1st, 2022, and who is your son, your daughter, stepchild, eligible foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of any of them, like a grandchild, niece, or nephew. They also can provide more than half of his or her own support during the year. And they also have to live with you for more than half of the tax year and must be claimed as a dependent on your tax return. Lastly, we have the electric vehicle tax credit. If you buy a new or plug-in hybrid, you may be eligible for a federal income tax credit of up to $7,500. Now, Biden's current Build Back Better bill aims to increase that credit to $12,500, up from the current $7,500. But here are the current requirements. You purchase the vehicle new. The vehicle has a gross vehicle weight under 14,000 pounds. The vehicle was designed to be driven on public roads. The vehicle is charged from an external source, aka plug-in. The vehicle has a battery pack with at least a 4 kilowatt hour capacity if four-wheeled and 2.5 kilowatt hour capacity if two-wheeled. The vehicle is largely set in motion by an electronic motor that draws electricity from a battery. You did not buy the vehicle with the intent to resell it, and you drive the vehicle primarily in the United States. Note that you are not available for the credit if you lease the vehicle. And some manufacturers, like Tesla at the current moment, are not eligible for the credit. I'm gonna place a few videos on the screen I think you should watch next. Be sure to check them out. Also, if you found this video helpful, do me a favor and hit that like button for me. It helps others to find this video on YouTube. And subscribe to the channel for more information that helps you save on taxes and build your wealth. I'm Karan from Life Accounting, and I'll see you in the next video.